Thanks for joining us once again. This is Greg. Today we take a look at some Warren Buffett ideas versus Tesla and its current stock price. We give you a preview headed into earnings next week. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We actually had some issues with cameras and Ubers, but have gotten through it, and therefore we're back. So my focal of discussion emanates from the fact that if you check the current PE ratio of Tesla, it exceeds 113 PE. So as you know, the way you usually get a PE is you multiply the amount of earnings times the growth rate, and you get a PE ratio. Prior to sort of the winning of Mr. Trump, Tesla's PE ratio was about half what it is currently. And so we've seen a nice run up that continues with the stock at $433 a share, which is the last I checked it today. So what I wanted to review is first, let's take a look at some PEs of other companies. The current PE of GM is about 5. The current PE of Daimler is about 4.33, and the current Ford PE is approximately 5 as well. So basically we're taking their earnings multiplied by 5, and that's what we're getting for their stock price. So what's going on here? Because those numbers are so wildly different. Clearly, the answer is that there are a lot of folks that are expecting Tesla to grow nicely, and the growth is reflected in the very high level PE, and therefore there's an expectation that the company is going to do phenomenally. Is that going to happen? Is the catalyst there? Well, the conversation I'm hearing about is that there are 2,000 to 5,000 robots currently in the factory, and if they become solid, that angle of growth for Tesla is a legitimate sort of increase in size of company variable. The second item that I would argue that's out there, as we're noting, is the fact that Tesla is about to come out with the semis at scale next year. So I believe that's starting to influence the stock price because we can see the factory being completed, and we know that the backlog of orders is rather large. So that would be a second catalyst. Clearly, the third one would be the fact that the sports car should be out latter part of next year, and that's another growth catalyst, even though the numbers would be low, given that the vehicle is so expensive. So yes, there are a number of growth areas, and obviously all of you are going to remind me of the fact that the mega packs are out there. There's another thing that just happened, and that is level 4 charging is now being introduced. And it turns out that the highest level of charging speed and capability is only going to be available for sort of the top end vehicles, and the rest of the vehicles will simply be charging at level 2 or level 3 speeds. We do have obviously sales of electric through Tesla to the semis that might come out as they go to these new level 4 charger facilities. So the question is, well, where does Warren Buffett come into play here? Because he doesn't invest in Tesla, and the answer to it is that the PE ratio gap between how fast the company is growing, which is at between 13 and 17% revenue growth each year, way exceeds where the stock price is relative to its PE. So this is not a stock that Warren Buffett can invest in. The next issue here is that Elon brought up the fact that Warren Buffett indicated that anytime the stock market is kind of like living in a house, and every day is somebody outside the house will yell a price. It's the same house, but the price keeps changing, was sort of the joke that was provided. I didn't think it was very funny, only because there's so many Tesla initiatives for growth that are lurking, including the fact that they could even get involved with, the large numbers of chips that they purchase from NVIDIA and what they're doing with Dojo and unique computing potentially is also another source of revenue that others have benefited from, and Tesla could benefit from it because it has all that equipment that can be moved in different directions to support clients in that space. So what I'm kind of getting at is that I'm starting to make the case for why we can see a $430 stock price that seems to be headed for $500 and why the stock doesn't crash the floor. So next, there are different ways to manage this heading into earnings next week and the post-Trump announcements and how they're going to impact Tesla. In particular, there are two ideas. Number one, we've talked often about hedging your position. You've made a lot of money, stock price is up. It's a good time maybe buy some puts, perhaps 5 to 10% of your portfolio. That way, if it pulls back 50 to 100 points, you haven't lost all that money. Another route that we shared or reviewed with a friend of our show based in San Diego was that because he has his Tesla holdings in his 401k, there's no tax if he simply sells out now, waits a week or two, and then buys back into his Tesla position. So there's no loss of value if in fact we see a severe pullback based on all the issues that are happening to the stock over the next week. And I think, that concept sounds good to me, and I think it's extremely wise, because if you think about how Tesla's stock price has moved over the years, we've seen 100% gains in 1 year, but six to 8 weeks of 70, 80% gains, from the 250s up now to the 430s, I'll call that 100%. So if you see that rapid blast up in the stock price, I really, really, really encourage you to consider taking some profits if you can in the manner that I just described. But if you're not going to sell out, at least a 10, maybe even a 20% hedge on your position is a wise move. Just a reminder, a hedge in this case would be you buy the puts, the stock keeps rising, you're in great shape because you already own the stock. So the money you spent to pay for the hedge or the puts will be addressed and the stocks continue to rise. On the other hand, if the stock falls, the value of your puts will increase, and that will allow you to sort of cover some of the losses you're losing as the stock price falls. Just my suggestion. The harder thing is if you're not in a 401k situation, that will be taxable. And if you sell out and then try to get back in. So this is a method that you can use, and there are a ton of exotic instruments that you can learn about on YouTube or read about relative to using options to manage your risk relative to this. So what do I think is going to happen? Well, I have to say, let me introduce you to something new that I haven't discussed in the past. So one of the things that happens in the stock market is there are different people with different powers. So, for example, a Goldman Sachs or one of the large hedge funds employs hundreds of people who are brilliant, be it PhDs or not. And one of the things those guys will do is they have access to tools that we do not. So the average investor like yourself or myself can borrow 50% of the stock that, up to 50% of the value of the stock you currently have, and then use that to do something else. You can buy a house with it, you can buy more stock, you can buy puts to hedge anything you want. That borrowing allows you, in theory, to buy double the share amount if you so choose. And the interest on those loans is deductible because it's an investment expense. So I kind of bring that up because, we're in a very, very unusual zone right now. Why do I say that? Right now, Warren Buffett has $300 billion sitting in cash, waiting to deploy that cash once the coast is clear in terms of him understanding where the Trump administration decides to take the economy. once that's decided, you could have a lot of cash coming back. Usually, the stock market isn't as high as it is, obviously, but usually a lot of people are on the sidelines waiting out to avoid having their portfolios smashed. So there's a lot of conflicting data that's sort of roaming through here right now. Obviously, we have the impact of the war in Russia. That's affecting oil prices. Oil prices are from the 68 range to the 78 range now in a week and a half. So there's extreme volatility that's going on. Now, getting back to Goldman Sachs, one of the things that elite traders can do is they can leverage their knowledge of the markets to do exotic instruments that allows them to lever up the amount of money they have under their control. That increased leverage allows them to have a lot more money to move the markets. So one thing I've been watching for, and I have not seen it, hence a slowdown even in my responding to what's going on in the investment community, is if you take a stock that's very large, like Tesla, and you have a group of hedge fund managers who push the stock price up, right? Well, they've done that through leverage. And usually what happens is that they can increase the stock price for a limited amount of time. And the reason is there's so many, the company is so large, it's very hard to move the stock price any direction up or down. But it is very hard to hold it at those higher levels. So what's amazing to me, and I still can't believe it, and I've been watching it for weeks, is yes, Tesla's stock price is up higher, but it's been able to maintain that height when I thought it was just going to crash back down at least 50 to 100 points lower than where it is now. And so I'm impressed because usually all of this would have played out in a 1 to 2 week period. We're in 6 weeks in now, and it's still, the process is still going. So I just wanted to say that because we're really breaking into new ground, new territory, new what's happening. The next point I wanted to make is, well, wait a second. If the stock price, let's say, went up well beyond the valuation of what the company's currently doing, there may be new news about new products or services that are dramatically going to help the earnings. And that's kind of being signaled by the $800 price target that's being given by people like I was going to say Wells Fargo, but actually Morgan Stanley gave a bull case of $800 a share for Tesla. I think that's possible, but it really depends on having the new products and services that are being sold to validate that increased stock price. And I have not seen that. So what I'm very surprised by right now is that there are large institutional investors who are forced to keep buying Tesla stock price on a regular basis. It could be because it's part of an index and it's become a larger percentage of that index, so I could see that. It also could be the fact that they're now comfortable with the higher valuations of the company based on a more prosperous future, and that's sort of supposedly where we are now. I have to say that I've been trained in the Peter Lynch, kind of Warren Buffett, value investing world, and I have to say that I don't get how Tesla stock price can get up to 400 or 430 even. And in essence, the numbers we were looking at 6 weeks ago were about the same, and they may be a little bit worse after we saw the delivery numbers we just had. So the answer is that we're headed into some unknown territory here. So it would be wise and prudent for you to be cautious and manage yourself carefully, because there could be big surprises, either up or down. I think it's going to be down, that we don't know about. But I think it's prudent and wise to be ready for whatever happens, and sort of we go from there. The final note I wanted to make to you that as a possibility that's going on, which I kind of feel like has to play into this, is the impact of hedge funds as well as, let's say, people like private equity firms and those guys taking, large institutions private. The more companies that are taken private, I'm told it's about 25% of the market has been taken private over the last 5 years. That results in all this money that needs to go into equities actually deciding we just have fewer equities. So you could actually have higher stock prices across the board simply because there are fewer companies. The answer to all this is going to be revealed, I'd say, in the next 60 to 90 days. I just wanted to encourage you to be cautious in the process because there could be some very dramatic changes very quickly. Once again, thank you for joining us for this portion of our talk. Next, let's move over into our health tips. So I've really been enjoying the process of learning more about better health, better eating, etc. The one discussion topic I wanted to bring up today is something called seed oils. So there's a term called canola oil, for example. And canola oil, they came up with the name because it stands for Canadian oil. It's a seed oil that was sort of invented, created in Canada, and it was originally used for lubricating a certain part of vehicles. And then they decided, oh, we could actually sell this as a food product as well. So what I've been informed of is the fact that seed oils are really hard on the body because it's a fairly new construction, and how your body sort of manages it long term could affect your health severely. So the recommendation is that you try an olive oil, perhaps coconut oil, or others, or avocado oils in that realm, but definitely not seed oils. And wanted to encourage you to think about that and include the process of looking at where you're eating your meals out of the house that might be using seed oils as well. It's especially like fries, etc. At any rate, I want to thank you for joining us. This is Greg for Teslafaninsight. Tschüss, au revoir, lehitrod, hoda haifez, draisite, nihama, arrivederci. And in Jamaica, we say enough respect, walk good man. Thanks for joining us. Have a great day, and bye for now.
Transition and quick. We are not in a good shape at the moment. Companies in Germany are slashing jobs, from car makers like Volkswagen and Ford to steelmaker Tsla. Thousands of jobs are on the line. So what does this say about the state of Germany and its future? Well, joining me now is Labour economist Nicholas Tsla from the Leibniz Centre for European Economic Research. Thank you very much for joining us. What do these proposed job cuts tell us about the state of German industry? Well, first of all, thanks for having me. It's a pleasure. Well, the state of the